Look at your charts right now. The retail market is in a state of absolute manufactured panic because the spot price of XRP slipped below the $1.40 macro support tier. The headlines are telling you that demand has evaporated. The mainstream commentators are telling you the bull run is over, they are lying to you. What you are witnessing is not a fundamental structural failure of the ledger. It is a highly engineered synthetic liquidation event. Over the past 24 hours, the derivatives market experienced a massive one-sided flush. According to the raw data from Coinglass, over 106,000 trading accounts were systematically wiped out. The total liquidations crossed $584 million. And here is the metric the media refuses to report. 89% of that damage was entirely absorbed by leveraged long positions. This was a targeted stop hunt designed to clear out speculative retail margin before the system undergoes its next major legislative transition. The capital did not leave the ecosystem, it changed hands. While high leverage long positions were being liquidated on public retail exchanges like BitGet and Binance, institutional custody wallets recorded their largest private spot accumulation block of the second quarter. If you are selling your spot coins right now because a leveraged derivatives trader got liquidated, you are executing the exact script the institutional desks wrote for you. To understand why this flush was triggered today, on Monday, May 18th, we have to audit the broader macroeconomic plumbing. The digital asset market does not trade in a vacuum. Right now, global financial conditions are tightening aggressively. The 30-year United States Treasury yield has aggressively pushed up to 5.13%. Concurrently, the options market has drastically scaled back expectations for Federal Reserve rate cuts throughout the remainder of 2026. When risk-free yields spike to these levels, institutional desks are mathematically forced to move into defensive, risk-off postures to protect capital efficiency. This macro tension created the perfect cover for market makers to sweep the public order books. By withdrawing passive buy liquidity from the exchange interfaces, they allowed the spot price to slide under 1.40, deliberately triggering the stop-loss clusters of hundreds of thousands of retail accounts. Look at this chart. The moment the liquidation algorithm finished hunting the retail stops, an immediate wall of passive institutional limit orders absorbed the volume at $1.38. The asset didn't drop because of coin-specific weakness. It dropped because the systemic plumbing required a clean leverage reset before the upcoming macroeconomic volatility index climbs higher. But the macroeconomic backdrop is only half the story. The real urgency behind this liquidity sweep is happening behind closed doors in Washington. Just 4 days ago, on May 14th, the Senate Banking Committee voted 15-9 to pass the Clarity Act, sending the most comprehensive market structure bill in history to the full Senate floor. Simultaneously, SEC Chairman Paul Atkins outlined a definitive 4-part agenda designed to fit on-chain trading systems directly into the federal securities perimeter. Specifically, the Commission is preparing to launch what they call a limited innovation pathway, alongside a complete revision of the broker and dealer definitions. Read between the lines of the regulator's own statements. The SEC is explicitly adjusting rules for systems where settlement is near instantaneous, and counterparty risk is managed entirely by on-chain algorithms. This is an explicit acknowledgement of the automated routing architecture embedded in the XRP ledger. They are changing the regulatory definitions because the legacy clearinghouse models cannot compete with native on-chain finality. The institutional players know that once this limited innovation pathway becomes operational, the availability of public spot supply on exchanges will effectively dry up. This is the critical inflection point where you must separate retail narrative from data-driven reality. The retail public reads the price print and screams, "collapse." The institutional desk reads the order flow, identifies the leverage wipeout, and quietly sweeps the desk clean. Your risk parameters must reflect the plumbing, not the panic. The $1.38 level has proven to be a highly guarded institutional accumulation zone. As we approach the Federal Reserve meeting minutes on May 20th and the final Senate floor vote preparations, expect the volatility algorithms to keep pounding the public order books. Do not let them engineering your exit. If your investment thesis is built on utility, the clearinghouse mandates, and the tokenization of the private credit markets, then a synthetic leverage flush is nothing more than a highly efficient entry window. If you want to see exactly how these newly cleared order books integrate with the XLS 80 protocol and the $1.7 trillion private credit vacuum we audited yesterday, click the linked video right here to watch video 3 from our Gold series. The data does not care about your feelings. Audit the plumbing. I'll see you on the next ledger stream.